Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Whose money is more valuable, yours or the bank's? It seems like an odd question, doesn't it? But let's dive into this. When we talk about value, we usually think of it in terms of dollars and cents. But when it comes to money, the concept of value is a bit more complex. It's not just about how much you have, but rather what you can do with it. And in the world of finance, the value of money can be drastically affected by interest rates. Let's consider two scenarios. First, imagine you have $100,000 and you decide to place it in a certificate of deposit. The bank offers you an interest rate of 5.2%. Sounds good, right? Now let's flip the coin. Instead of investing your money, you need a loan. The bank offers you a line of credit of $100,000, but this time the interest rate is 9.5%. And what's more, this loan is collateralized against your property. When we talk about loans, there's a term you might have heard, collateral. Collateral is an asset that a borrower offers to a lender to secure a loan. If the borrower defaults on their loan payments, the lender can seize the collateral and sell it to recoup their losses. You might be wondering, why such a stark difference? Why does the bank only offer you 5.2% for your money, but charges you 9.5% for theirs? The answer, my friends, lies in the power dynamics of the banking system. Banks are businesses, and like all businesses, they're in it to make a profit. The higher interest rate they charge for loans helps them do just that. But there's another layer to this. The disparity in these interest rates isn't just about making money for the banks. It's also about controlling risk. When you deposit your money in a bank, it's considered a low-risk investment for the bank. But when the bank gives you a loan, especially one collateralized against your property, the risk is much higher. Hence, the higher interest rate. So, you see, there's more to the value of money than meets the eye. It's not just about the amount, but also about the power and potential it holds. And in the world of banking, it's clear that not all dollars are created equal. Trust is a tricky thing, especially when it comes to your hard-earned money. Banking systems, while often portrayed as the safest place to store your wealth, come with their share of perils. The first and foremost risk is that of bank failures. While it's not an everyday occurrence, it's not unheard of either. Remember the Great Recession of 2008? Many banks collapsed, wiping out people's life savings overnight. Now, you might think that your deposits are insured, and you're not wrong. However, the insurance, under the Federal Deposit Insurance Corporation, only covers up to a certain limit. In the United States, it's $250,000 per depositor, per bank. So, if you've been diligently saving and have amassed wealth beyond this limit, the excess amount is at risk, but the perils don't stop there. Let's talk about the Frank Dodd policy, a regulatory reform passed after the 2008 financial crisis. It aimed to reduce various risks in the U.S. financial system. One of the provisions under this policy allows banks to use depositors' money to cover their losses. This means that in a financial crisis, the banks could legally confiscate your deposits to stay afloat. So, you see, when you deposit your money in a bank, you're essentially lending them your money. And while you earn a meager interest of 5.2%, the bank lends your money to others at much higher rates, say 9.5%, and keeps the difference. This model not only destroys generational wealth by keeping the majority of the population in a cycle of debt, but it also exposes you to the risk of losing your money in the event of a bank failure. In essence, your trust in the banking system is a gamble. You're betting on the bank's ability to manage your money efficiently, to not fall into bankruptcy, and to not dip into your deposits when times get tough. So the more you trust the system, the more you stand to lose. What happens if you default on the line of credit? What happens to your money if the bank fails? Now, let's delve into the potential consequences of these scenarios. When you default on your line of credit, the bank can initiate a process known as foreclosure, where they can seize your property, sell it, and use the proceeds to pay off your debt. It's a harsh reality, but it's also a risk you accept when you collateralize your property. This could potentially lead to you losing your home, which is a devastating blow, not only to your present situation, but also to your future financial plans. On a broader scale, defaulting on your line of credit can tarnish your credit history, making it more difficult for you to secure loans in the future. It's a downward spiral that can be tough to break free from and can lead to long-lasting financial repercussions. Now, let's shift our focus to the banks. What happens to your hard-earned money if the bank fails? Well, in the wake of the 2008 financial crisis, the Dodd-Frank policy was enacted to prevent such an event. However, this policy also allows banks to bail in, meaning they can legally confiscate your deposits to offset their losses. Sounds unfair, doesn't it? This means that your $100,000 deposited in the bank is not as secure as you might think. If the bank were to fail, you could potentially lose all your savings overnight. This is not just a loss for you, but it also disrupts the financial stability of future generations, contributing to the destruction of generational wealth. The banking system, with all its complexities and intricacies, can sometimes work against us, the depositors. And while we often trust these institutions with our life savings, it's crucial to be aware of the potential risks and consequences involved. It's a scary thought, isn't it? But it's a reality that we need to face. So, whose money is more valuable, yours or the bank's? The answer might not be as clear-cut as you'd think. Let's recap. We've explored the disparity between the interest rates offered by banks for your deposits and what they charge for their loans. We've seen how a non-collateralized certificate of deposit, despite its seemingly attractive 5.2% interest rate, pales in comparison to the hefty 9.5% interest the bank charges on a collateralized line of credit. This disparity not only questions the value of your money against the banks, but also acts as a wealth destroyer. Generational wealth, painstakingly built over decades, can be eroded due to the imbalance in the banking system's favor. We've delved into the perils of trusting the banking system blindly. When you default on a line of credit, your property is at risk. But what happens to your money if the bank fails? It's a chilling prospect, and one that brings into focus the implications of the Dodd policy. This policy, while designed to prevent a repeat of the 2008 financial crisis, has its own set of implications. One of the most alarming is the potential for banks to confiscate your deposits. This, again, highlights the need for vigilance and financial literacy. Knowledge is power, and nowhere is this truer than in the world of finance. Making informed decisions about your money can be the difference between building wealth and seeing it whittled away. Understand the value of your money, the ins and outs of the banking system, and the potential risks involved. Remember, it's not just about whose money is more valuable, it's about understanding the system, navigating its pitfalls, and making it work for you. It's about being proactive, informed, and vigilant. Remember, knowledge is power. The more you know, the better decisions you can make about your money. Now that we've discerned the possible downsides of depending solely on the banking system, let's delve into diverse alternatives that might better meet your financial goals. While banks indeed hold a noteworthy role in our economy, it's imperative to acknowledge they're not the sole participants in the game. There are also other financial institutions and investment opportunities which may proffer superior returns and heightened security for your hard-earned money. Take credit unions, for instance. They generally propose higher interest rates on savings accounts and lower lending rates. As they are member-owned, they typically prioritize your best interests. Furthermore, commodities like gold, silver, or oil can be a promising investment alternative, providing potential hedge against inflation and currency fluctuations. Raw land investment is another avenue that can be highly profitable and worth considering, as it tends to appreciate over time. Investing in stocks, bonds, or mutual funds can yield higher returns over an extended period, though they come with their own risks and necessitate careful contemplation. Real estate, as a tangible asset, is another promising path. It can generate a regular income stream and appreciate over time. Additionally, peer-to-peer lending platforms can put forward competitive returns, albeit they too carry certain risks. Lastly, never underestimate the worth of investing in yourself, be it through education, initiating a business, or acquiring a new skill. These investments can reap substantial returns over time. Remember, diversification is the key. Spreading your investments across diverse asset classes can aid in risk management and potentially amplify your overall returns. The objective here is not to circumvent banks entirely, but to comprehend that they are merely a part of a larger financial landscape. By probing and comprehending these alternatives, you can make more enlightened decisions about where your money will be most fruitful. Thank you for joining us on this exploration of the banking system's intricacies and the profound significance of your money. We trust this video has not only been insightful, but has also equipped you with the crucial knowledge necessary for making informed decisions about your finances. It's essential to continue this journey of learning, questioning, and understanding the system that we're all participants in. Remember, the value of your money isn't confined to the digits on your bank statement. It has substantial power, the power to generate wealth, ensure security, and carve your future. It's crucial to note that your money is just as valuable as the bank's, and it warrants the same protection measures that banks use. But remember, with great power comes great responsibility. So, be vigilant, stay informed, and always be proactive. If you found this video helpful, please like it, leave a comment with your thoughts, or share it with someone who might benefit from this information. And don't forget to subscribe to our channel for more insightful videos like this. Your support enables us to produce more content, and we greatly value it. Thanks for watching, and until next time, stay financially savvy and guard your riches as the banks do theirs.